All of the different ways of reading price action that you see here, none of them will actually make you profitable without the concept I'll teach you today. Trading was really hard until I understood and applied this concept, even though it's so easy to understand and apply. However, a lot of people decide to overlook it. Either you trade smart money concepts or ICT concepts, candle patterns for examples, or supply demand. A lot of people trade those patterns when it comes to supply demand, Wyckoff, Fibonacci, or pure market structure. All of those ways will not work without the thing that I'll teach you today. That's what you need to understand. And that's something that I discovered after years and years of trading, because not a lot of people actually mention this. What they focus on is the pattern or the strategy itself and not the concept I'll teach you today. So make sure to stick until the end. That's going to be a very valuable lesson to you. Let's get into it. Starting with consolidation versus expansion. Now, let's imagine that you enter at this green box. This is your entry area or zone. Definitely you had this experience before. Price comes to, a specific zone. You enter from here, and then price from nowhere start consolidating and, ranging. So price is basically not expanding in what direction. However, it's ranging, creating highs and lows without going into one direction. And here, what's going to happen is you either close your trade, or you would, go break even, and it's going to hit your break even, or go to your stop loss. So it's going to take some time and then just go and take your stop loss. This happened for a reason, as well as this happened for a reason. When you just enter sometimes and you feel like, oh, you're getting those snapper entries, this is what I'll be teaching you today. Very valuable lesson. So price comes to a zone. What's going to happen is price simply come in here and then expanding higher and not consolidating the same as this. So price will go higher, go and hit your take profit. That's our focus. Now you ask yourself this question: how do we actually differentiate between the two scenarios and the two conditions? We're gonna cover all of this, and there is actually a psychological relation for this. A lot of people actually, when they have this condition, for example, or this scenario, what they're going to say is, why when I enter a trade, it's actually ranging, and when I'm not entering, it's expansion. And it's not a psychological thing. It's not about you, because the market doesn't really care about no one. It's about where you enter and how good that area is. So for now, what we're going to do is go over TradingView and show you this in real chart, and then we'll come back to the slides. This is the euro and US dollar chart. What we can see is that a lot of the time price actually consolidating. So you see here, but at some specific zones, and a lot of people actually get engaged and participate in the price action in the market at those times. And what is the result? Either losing or maybe going break even, right? So nothing here, not the biggest move that you're going to experience. However, what happened here? You see at this specific point, as well as this one, and the same thing here and here, there's actually a relationship between those points. So it's not just randomly picking the highs and lows. There's something that is there that caused the price action to expand and to be aggressive at that point, not ranging. And the same thing applies here. So if you see, if you go zoom in here, what you see is a lot of ranging, but at this specific point, what we had is expansion to the lower side, as well as here, only aggressiveness to the upside right here, and then retracement, and then again, same thing happening here, you see, as well as here, we only get expansions from those points. Now, how do we trade only based on those and ignore all of the noise and all of the ranging condition? That's what you're going to learn on the next slide. And the concept that you really need to apply and add to your trading plan is top-down analysis. It's one of the most overlooked concepts, as well as one of the most misunderstood concepts. So a lot of people actually explain this in a wrong way, and one of the examples is just going, randomly starting off weekly time frame, then going to 4-hour time frame, then daily time frame, then 15-minute, then trying to catch a trade on 1-minute time frame, and trying to align all of those time frames together. That's not the right way. It's just that it's almost impossible for all of those time frames to align at some point. Sometimes you'll see the daily going bullish while the 4-hour is being bearish, and then the 15-minute is being bearish. Where do I go? Absolutely bearish, because if we are entering on the 15-minute, then we gotta follow the 4-hour, and we don't care about the daily being bullish, because it's a retracement on the 4-hour, and that's what we are trying to trade. So the right way is what I'm going to teach you in this video. First of all, what is top-down analysis? It's analyzing the price action based on multiple time frames. And in other words, it's looking at the big picture first and then analyzing the details. So, I have a big picture here. I'll look at this and say, okay, I like this. Let's look at the details and then, go from there. Why do we need it? Why we need top-down analysis? We need it to trade with the bias. A lot of people actually explain, including me, I do explain daily bias. But what is daily bias at the end? It's nothing but top-down analysis. We're trying to align our trade. For example, if we're looking at the daily bias and that's what we care about, then we're going to try to find alignment with the daily time frame. We also need top-down analysis to catch expansions. And what is that going to result to? High reward to risk. If you see a lot of people just aiming for one-to-one using, specific pattern, actually, if you use top-down analysis also using the same pattern, we can achieve 3-to-1 instead, only by applying this concept. Now, how do we perform the top-down analysis? It's going to be using multiple time frames, and we're going to look for the alignment. We can use 3 time frames or 2 time frames, and each one has its own pros and cons. We're going to cover that on the next slide. And from there, we're going to go to the chart and show you how to actually use it and how to take advantage of it. So again, we discussed what is it, but in other words also, it's catching small parts. So let's say we're looking at 4-hour time frame, right, as our higher time frame, and you want to look at 15-minute time frame to enter a trade. Then our reference will be the 4-hour. That's how you see, for example, 2 candles on the 4-hour, and that's how you see multiple candles on the 15-minute. So you see how what we are trying to do here is catch a small part of the 4-hour time frame. So I don't need to catch, a big part of the 4-hour. No, just a small part of it, maybe something like this, or 1 candle or 2 candle. It depends on how big the candles are. But you see, small part of the 4-hour time frame, maybe the 4-hour candle, and it's going to be a really big part on the 15-minute time frame. You see, we have 4-hour zone. This is how it looks on the 4-hour. We're using 4-hour zones in order to enter on the 15-minute, and that's how you see it. Big move, tighter stop loss, and then very nice entry, and then big targets. All of those things are going to be there by using top-down analysis. Now the 4-hour and the 15-minute is an example, but we have different ones for all types of traders. So to perform the top-down analysis, we can either go with 2 time frames or 3 time frames. The one with 2 time frames would be just by using 1 time frame as a bias and another time frame for entry. The 3 time frames would be using 3 time frames, 1 as a bias, and then 2 as a confirmation or to find a point of interest, and the third is for the entry. Now, even though this is more confirmation, but this is more beginners friendly, I really recommend people to follow the 2 time frames because you don't need all the stress that is involved with the lower time frame entry. So maybe go with this. Those are the time frames. Now, as we go up, we have list trades because this is more for swing traders. The more we go lower, more as a lower time frame entries and more as scalping trades. So 15-minute, 1-minute time frame, for example, it depends on what do you prefer as your entry. So start from your interest. So let's say I really like to enter trade based on the 1 hour, then 1 hour is your entry. It means that I need to look at the daily for my bias and for my higher time frame analysis. And using the 3 time frames is going to be weekly, 4 hour, 15 minutes. So that means on the weekly, I'm going to be looking for just the bias, maybe a zone on the weekly. On the 4 hour, I'll be looking for a zone to be created at the 4 hour zone, right? And then I'll be entering on the 15-minute. Same thing here. This one is more confirmation. This is more for advanced traders. It doesn't mean that you at this point need to follow the 3 time frames. You can actually do much better with the 2 time frames. But if you are advanced and you think that you are already a good trader, you could go with the 3 time frames. Make sure to pick 1 time frame alignment now and start trading using that one, and you will see a big improvement in your trading journey. I really promise you that. Otherwise, you did not master the concept correctly. Those are the time frames. It's much simpler than you think. That's why we need to cover some examples now. So looking at the current price action, this is euro dollar. This can be applicable on any time frame, any time frame alignment, because we discussed 2 time frames or 3 time frames. It can work on any asset and any time of the day, but you need to pick the right setup. But let's now take the most stupid thing. So let's say we're just trying to trade engulfing candle. So for example, let's say bearish candle, just like this, that was followed by a small bullish candle. So something like this, okay? That's a bullish candle. And all what we're looking for is a strong bearish candle. That's the pattern. If we go look at the current price action here, you're gonna see that a lot of the time, and let's target 3 to 1, for example, right? And stop loss goes above the last swing high. You can see that we have one that is here. We have one engulfing candle. We enter here, but then you see price comes back, maybe stopped out at break even. We can also see that we have one engulfing candle here. We could have entered on this one, stop loss below the low, target 3 to 1. This one is stopped out. We also have another one, for example, here. We have this one. This one, it might be working, but you see there are a lot of times where it actually doesn't work. For example, this one. You see, we have bearish candle engulfing the previous one. If we enter from here, stop loss above the swing high, it gets to the stop loss. Sometimes we don't get the perfect entry. So how do we deal with that? One simple thing. So let's say we are trying to find that engulfing candle at the 15-minute time frame. What we're gonna do is not do that, but go to 4-hour time frame first. We're trying to find this engulfing candle pattern in POIs, in higher time frame, in this time 4-hour time frame. So for example, we got this 4-hour bearish fair value gap. We're only looking for bearish engulfing candle in this bearish fair value gap on the 15-minute time frame. Same thing here. You see we got this bullish fair value gap. We're looking for the engulfing candle in the zone. Same thing here. We got this big bullish fair value gap. We're looking for the engulfing candle at this. When we're switching to 15-minute time frame in this case, in this time, so we did not have an engulfing candle here, but in another one, for example here, we can see that we get this one. You see we're inside of that higher time frame, in this case 4-hour fair value gap, and we got this engulfing. This is now a higher probability one. If we go stop loss, for example, above the swing high, targeting 3 to 1, this is where you get your 3 to 1. Otherwise, it's going to be kind of ranging in other scenarios. So if you just enter from any other engulfing candle, it's going to be most of the time in a ranging condition. That's how we only focus on the expansions and the aggressiveness. You see? Same thing here. We get this big one, that's a valid one. But in this case, that's a very, very big one. It's not the highest probability. Same thing here on this day. What we see is price come into that fair value gap. Nothing here, none of the patterns that we are interested in. But we get this one, engulfing candle at a key level. That's the one that should work. All of the others can be in a ranging condition. And you see, easily 3 to 1. This is 4 to 1. So 3 to 1 is achieved here. But if we look at another one, for example, this engulfing and then stop loss above the high, targeting 3 to 1, we don't get even to 1 to 1 in this case. Why? Because this engulfing here is not part of a higher time frame fair value gap or higher time frame POI. Any point of interest you can use, not limited to fair value gaps, but it's just that fair value gap is my favorite thing. So you see, no fair value gap here, even though we had a reaction, a small one, but you don't get that high reward to risk, at least 3 to 1. Now the same thing on the 1 minute. So let's say a lot of people like to scalp based on the 1 minute time frame. One way to do some scalping, for example, based on highs and lows, liquidity sweeps, and tether sweep. I have a lot of videos about how to pick the right liquidity sweep and tether sweep opportunity. But simply, we got to look at the 15-minute time frame and a sweep of a 15-minute time frame liquidity level. So you see all of those equal lows here. Sweep of this. We're going to look at the 1 minute time frame and enter based on this engulfing candle, for example. So that's our entry. And the stop loss goes somewhere below the low. Almost can go to 5 to 1 or the next high. It actually went to the next high. That's a 4.5 to 1. That's how you get those high reward to risk. That's all about top 10 analysis. We keep it simple. We follow the time frame alignment, and that's it. So I really hope you guys like this video. If you do, then make sure to share it with your friends. Hit the like button. Leave a comment with any video ideas or suggestion to do in the future. That's it for today. I really wish you the best, and I'll see you next video.